Hello, everyone. Welcome to MSS Mentorship and Online Classes. Today, we are going to focus on the introduction to financial reporting and the conceptual framework. My name is Mohamed Sheikh Sise. I am your tutor and your mentor. We are going to look at the purpose of financial reporting, the benefit of financial reporting, and the users of the financial statements. When we are talking about financial reporting, this is the process of preparing and presenting financial information, which is very much important. When we are talking about financial information, we are talking about the revenue, we are talking about the cost of sales, we are talking about the expenses, we are talking about the assets, the liabilities, the equities. So the purpose of financial reporting is how we can prepare, how we can consolidate, how we can put together these financial information, and also how we can present. How are we going to show these financial information about a company or an organization, which is very much important. This is the holistic information. This is the holistic concept we need to know about financial reporting. We need to know about financial reporting in twofold. One has to do with how are we going to prepare the preparation of the financial information. How are we going to do the preparation of the financial information? And also, how are we going to present, how are we going to show this financial information about a company or an organization? So what will be the benefit? Why are we going to prepare and present this financial information? This is to ensure that the users of the financial information, the stakeholders of the financial information, understand its financial position and performance as well. So this is very much important. The basis of why are we going to prepare and present the financial information is for the users of the financial information to understand their financial performance and their financial position. For instance, if we are talking about the government, looking at the interest of the government, they need to know the amount of profit the company is generating. They need to know the compliance level in terms of regulations, in terms of rules, in terms of new policies and procedures, how the company can confront, how the company can ensure compliance with statutory laws and regulation. So we are going to prepare the financial performance and the financial position to ensure that the government knows the amount of profit the company is generating and how the company can pay its tax to the government. So this is very much important for us to know that the financial reporting preparation and presentation is to ensure that the stakeholders or the users of the financial information understand its financial performance and position. It is a key part of accounting, corporate governance, to ensure providing transparency and accountability with a clear and chronological order in the preparation and the presentation of the financial information. This can result to a significant transparency and accountability. So we need to note these points down and we need to understand these points. Financial reporting provides useful information about the financial position, performance, the cash flow of an entity as well. So we need to look at the primary objective of the financial reporting. This is to provide useful financial information about the reporting entity that is useful to the investors, the lenders, and other creditors in making an informed decision about providing their resources to the business. For example, the investors, they want to see the performance of the company, they want to see the profitability level of the company, they want to see the liquidity status of the company, they want to see the amount of debt the company has, they want to see the risk exposure of the company. They want to see how curious the company is with regards to environmental issues, with regards to sustainability, with regards to corporate social responsibility. So these the investors want to know all of this information. So the financial reporting will ensure providing this information to the investor so that the investor can have a comfort, can have a reliability about their investment. So now we are going to look at the user's financial statement. This is very much important. We need to know the stakeholders who has interest in the day-to-day operational activities of the business, of the company, of the organization. To start with, we are looking at the investors. Investors, their own interest will be looking at their return on investment, which is very much important because if anyone decided to invest their money, they want to see return. They want to have some amount of, you know, comfort that their investment is in the safe hands. Also, on an annual basis, they want to receive dividend, but we are going to look at it in different standards, whether we are going to issue out dividend or not, we are going to look at it in separate fold. But basically, this is the interest of investors. Also, for looking at the potential investors, their interest will be looking at how the company has been performing over the previous years, looking at their compliance in terms of laws and regulation, looking at the sustainability issues, looking at the corporate governance issues as well. So now we are looking at the lenders. Their interest, they are more concerned about their repayments. What is the current situation of the company in terms of repaying their the outstanding amounts that they need to receive. So this will be the interest of the lenders. They want the repayment capacity, that the company has the ability to repay the amount. We are looking at the employees. The interest of the employees with relating to the financial statement is to ensure, stability. They have job security. Also, they receive good payments and also they have future with the company in terms of pensions and they need to have that assurance that in the event of liquidation, the company will be in position to pay the end of service benefits to all employees. So this is the interest of the employees. They need stability, they need good pay, they need pension, and they need job security as well. So we are looking at the suppliers. Also, they want to see the ability of the company to pay back their amounts. For instance, if we are looking at the creditors, they want to have that assurance that they are going to receive the money. They are going to receive the money as per the contract agreement between the company and the suppliers. Finally, we are going to look at the government aspect, which is very much important. They want to know the profitability status of the company so that they can collect tax, so that the company can be able to pay tax. They also want to know the compliance issues, whether the company is in compliance with laws and regulation. For instance, if we are talking about the manufacturing company, if we are talking about the mining company, if we are talking about the insurance company, all of these companies, have their own laws and regulations that underpin their operational activities. So it is the responsibility of the government, it is the interest of the government to ensure that all statutory laws and regulations are in compliance. So this is the interest of the government relating to the financial statements. So all of these users of the financial statements, you know, looking out for something special within the financial information. So if only the financial reporting process, the process of preparing and presenting the financial information is good, is fine, then it means all of these users, all of these stakeholders will benefit from the financial reporting. So it is important to understand that financial reporting serves external users primarily, but also benefits internal stakeholders. The government is an external stakeholder, the supplier is an external, the investor is an external, the lender is an external, but also it provides benefits to the internal stakeholders, the employees and others. So now, this is the purpose, and these are the users of the financial information. So we are going to look at the regulatory framework, which is very much important, as the regulatory framework refers to a set of rules, standards, and guidelines that govern the preparation and presentation of the financial information. So now let's understand the link between the purpose of the financial reporting and the regulatory framework. Now, the purpose of financial reporting is to ensure the preparation and presentation of the financial information. So now, if we are going to prepare and if we are going to present this financial information, we need a rule, we need a standards, we need a guidelines, we need a chronological approach to ensure that we prepare the financial statements and we present the financial statements in a consistent and orderly manner. So what will be the benefit of the regulatory framework? Because it is very much important for us to know and to understand that these set of rules, these standards, these guidelines will govern the preparation and the presentation of the financial information. Now, for instance, let's assuming we have two companies, both are manufacturing companies, but they are manufacturing different items. So now let's assume they are presenting their financial information in an orderly manner, in a structured manner. For instance, when we are talking about their income statement, they prepare the sales, the cost of sales, the expenses, and we have the profits. But when you're talking about the other company, they decided to prepare the financial statement, ignoring the sales, or they just place a single figure for cost of sales without, for gross profit without showing the sales, without showing the cost of sales. They decided to present the information in their own manner. So this is the basis and this is the rationale of the regulatory framework to ensure that everyone that is preparing and presenting financial information are in consistent with one another. So the basis of the regulatory framework is to ensure that the financial statements are consistent. We need to see consistency in the preparation of the financial information. We need to see consistency in the preparation of the financial statement, which is very much important for us to understand. Also, we need to see transparency. We need to see what the standard is requiring for us to do and how are we going to adopt and implement these standards throughout the preparation of the financial information. So we need this transparency, and the regulatory framework can give us the assurance that our financial statement is consistent, our financial statement is transparent. And also, we need to see the comparability. it is important that we are in the position to compare the financial statement from one period to another, or from one company to another, or from one industry to another, depending to the profitability index. And anyway, let me don't go into that for now. So this is the basis of the regulatory framework to ensure the consistency in the preparation and presentation of financial statements, transparency, and ensure comparability. That is where we need to be able to compare the financial statement from one period to another. So we are going to look at why a regulatory framework is necessary. Regulatory framework or regulation of accounting information is aimed at ensuring that the users of the financial statements receive a minimum amount of information that will enable them to make meaningful decisions regarding their interest in the reporting entity, which is very much important. Most of the users of the financial statements, they are not, an accountant. They are only concerned about their interest in the financial statements. So the essence of this regulatory framework is to ensure that we prepare and present the financial information at minimum, at best, whereas everyone with or without accounting background can able to, to read and make a meaningful decision out of this financial information, which is very much important. Also, a regulatory framework is required to ensure that relevant and reliable financial reporting is achieved to meet the needs of shareholders and other users. Very crystal clear, we need to get these points clear. Accounting standards on their own will not be a complete regulatory framework. We need to know this as well. The IASs, the IFRSs, they are not alone complete to be a regulatory framework. In order to fulfill a regulatory framework, the preparation of the financial statements and the obligations of companies and directors, legal and market regulation also required. So we are not going to look at only the IFRSs, the ISs in the preparation of the financial statements. We need to look at the regulation, we need to look at the directors, the legal, we need to look at the market regulations, all of these factors, need to be considered in the preparation and the presentation of the financial information, the financial statement. So now we are going to look at the principle-based and the rule-based framework, which is very much important. We have two framework, principle and the rule-based. Let's look at the principle, which is based upon the conceptual framework, such as the International Accounting Standard Board framework and also the accounting standard, and are created using the conceptual framework as a basis. So when we are going to look at our next tutorial on conceptual framework, we are going to explain in detail, the basis, why the conceptual framework is important, and also how are we going to use the conceptual framework in line with the IFRSs and the IESs to ensure there is a consistency in the adoption, in the application of the conceptual framework and the IFRSs and the IESs. So this is a principle base. It is a principle that we need to treat PPE in accordance with IAS 16. It is a principle that we need to treat leases under IFRS 16. It is a principle that we need to treat revenue under IFRS 15. It is a principle that we need to treat asset and liability, or we need to treat financial instruments, financial assets and liability under IFRS 9. So this is a principle. So now we are going to look at the rules-based framework, which is the cookbook approach. Accounting standards are set of rules which companies must follow. Basically, when you're talking about the cookbook approach, we have a lay down rules and regulation. You need to comply with some ethical issues, with confidentialities, the preparation of the financial statement, and also, some countries, have their own lay down, policies and procedures in terms of how are you going to present certain, company information. For instance, if we are looking at the public, company information, if we are looking at some non-governmental organization information, they have their own, cookbook approach in the preparation and the presentation of the financial statement. But however, all this financial information should be in line. There should be a consistency in the preparation, there should be a transparency, and there should be a comparability in the preparation and the presentation of this financial information. So now we are going to look at key components of the, the regulatory framework, which is very much important for us to know. And these components form the financial, the conceptual, the regulatory framework. So one of the components is the accounting standard, the IFRSs and the IESs. They provide detailed rules for recognition, measurement, and disclosure of transaction in the financial statements. With the ISCs and the IFRSs, we can able to know whether we need to recognize a particular transaction or whether we just need to disclose this particular transaction. And we are going to look at the measurement aspects of this transaction and how are we going to disclose this transaction. For instance, if we are talking about IAS 24, a related party transaction, when there is a related party transaction, we need to know that the primary focus is to ensure that we disclose this information to the users of the financial statement so that they can aware that there is a relationship between the director and the CEO, or there's a relationship between the director and the auditor, whichever nature of related party transaction, need to be disclosed to the users of the financial information. So this is the aspects of accounting standard. Also, we have the legislation. These are the laws that require companies to prepare financial statements, you know, just as it is a mandatory law, for companies to have an audited financial statement. This is a law, this is a legislation. Example, the Company Act in various countries, it gave the right for company to prepare a financial statement. It's obviously that any company can prepare a financial statement so that the users of the financial information can able to know, the status of their interest in that particular entity. Also, we are going to look at the conceptual framework, and we are going to look at it in detail. But for now, we are going to look at the objective of financial reporting, the useful for decision making. We are going to look at the qualitative characteristics of financial information, and also we are going to look at the elements, of the financial statement. What are the makeup, of the financial statement? Then finally, we are going to look at the regulatory bodies. You know, we have regulatory bodies that are responsible to ensure compliance and enforcement of the regulatory framework. For instance, we have the International Accounting Standard Board, the IASB, and then they are responsible to issue IFRSs and IASs. So they need to issue IFRSs and IASs, and they need to ensure the standards are updated, they are realistic, and also the standard need to be enforceable. Need to ensure that all companies, all organizations, are in compliance and they are enforcing the IFRSs and IASs in compliance with the International Accounting Standard Board. Also, we are looking at the Financial Accounting Standard Board, FASB. They also have responsibility as a regulatory body to ensure the compliance, and the issuance of the relevant accounting standards. Also, we are talking about the Security and Exchange Commission, related to public companies in the United States. These are all the regulatory bodies that are responsible, that are governing the application, the adoption, and the enforcement of compliance with relating to the preparation and the presentation of the financial information, the financial statement. So now, let's look at the objective of regulatory framework. One objective of regulatory framework is to ensure consistency in the financial reporting. We need to have consistency. It is key. Consistency is key in the preparation and presentation of the financial statements. For instance, if you are going to show a single line sales figure in the financial statement, in the income statement, then you need to be consistent. Year on year, you need to show a single sales figure. Whereas to the notes to account, you are going to show the breakdown, the different components of sales revenue you are generating, for each type of revenue stream you are using to generate your revenue, you need to state it in detail. So basically, the income statement will only show a single line of sales, while the notes to account will show a detailed breakdown of the sales revenue. So this consistency needs to be maintained year on year. Also, the objective of regulatory framework is to improve comparability between companies. We need to be able to compare the sales of 2025 as to the sales of 2024. We need to compare the sales of manufacturing company, which is manufacturing, let's say, chair or whichever product. We need to compare the revenue from one manufacturing company to another. We need to compare the assets of one company to another. The comparability will improve with the help of the regulatory framework. Also, it provides reliable and relevant information for users. For instance, with the regulatory framework, we can able to provide relevant information to the users, to the government, to the creditors, to the investors, to the employees. Also, the regulatory framework supports trust and accountability in financial markets, which is very much important. The conceptual framework supports how the trust and accountability can be developed and can be adopted in the financial markets. Trust and accountability, it is a difficult and it's a broader aspect in the preparation of the financial statement. And then, by the way, we're going to look at it on our journey throughout the ACCA course, and also it is very much important. We need to understand it is the responsibility of the accountant, whoever is responsible to prepare and present this financial information to ensure trust and accountability is achieved. So to round it all, this is the summary table, and we need to look at the components and the role. Looking at IFRS and IASs, there are accounting rules for recognition, measurement, and disclosure. We are looking at the legislation, legal requirements to prepare a financial statement. We are looking at the conceptual framework, which provides objective principles and qualitative characteristics. And we are looking at the regulatory bodies. Those are the enforceable individuals, ensuring that standards, compliance are achieved within the day-to-day operation activities and the preparation and the presentation of the financial information. So this is all we have under the introduction to financial reporting, and our next video will be exclusively on conceptual framework. We are going to explain in detail about conceptual framework, and we are going to solve past questions, ACCA past questions on conceptual framework and what we have covered so far. So thank you all.